Welcome to our coverage of financial statement analysis. We are covering this in an online format because many of these concepts will be a review of your first accounting class, and this will allow you to go at the pace that you're most comfortable with. Now, what you'll want to do is get out your lecture notes for the financial statement analysis chapter, and also just be prepared to fill in as we would as if we were sitting in class. Also, if you will go to near the end of the lecture notes, you will find an example called Aggie Inc. You'll see the financial statements for that, and all of the ratios and computations we're going to make will be based on that first example. It looks like this. We'll have a comparative balance sheet for Aggie Inc. You see an asset section and then a liabilities and equities section for the balance sheet. And we've got 2 years, 2009, 2010. Then we also have comparative income statements, again 2009 in the far column and then 2010. And then we have some additional information. It says the current market price for the company's stock is $36 per share, and common dividends totaling $5,900 were paid during 2010. Assumed dividends are paid at the end of the year and the tax rate is 20%. All right, so reference those as needed as we cover the various topics in this chapter. Now first we want to understand what is financial statement analysis. And all it is just a set of tools used to make the general purpose financial statements more useful for a variety of users of financial information. So if you think about the users of financial information, we are talking about investors and creditors, both short-term and long-term creditors, sometimes governmental agencies. And so we want to take these general purpose financial statements and make them where the information is more relevant to a specific user's needs. Now there's going to be 3 basic tools of analysis in this chapter: horizontal analysis, vertical analysis, and ratio analysis. In this first presentation we'll cover both horizontal and vertical analysis. Then ratio analysis will be covered in the remaining 3 presentations. Now as we move into these techniques for evaluating financial statements, it really is important that you keep in mind that for the analysis to be meaningful, you really need to make some kind of comparison. You don't just want to look at a certain ratio for a given year and identify that it's either good or bad. Now some of the standards that we can compare against, we can look at past history of the company, and oftentimes we do. That helps us to identify trends and just see what's happening within, say, PepsiCo over time. We can compare to a similar company. Now that does present a couple of problems. First of all, it is hard to find a similar company sometimes. For example, PepsiCo and Coca-Cola are both in the beverage industry, but you might find that given the other product lines they carry, they are very different companies. But the bigger problem is differences in accounting methods used, and it's hard to see through those sometimes. So another very common thing that we do is make comparisons to industrial averages. And there are certain organizations that collect information for various companies over time, and they take this data and publish it. And some examples of this is Moody's, Standard & Poor's, or Dun & Bradstreet. So you could compare a current ratio of PepsiCo to the beverage industry, which would be an average for the larger companies in that industry. Now the first technique, horizontal analysis, is also sometimes called trend analysis. It does focus on the dollar or percentage change in the accounts in the income statement and balance sheet from one year to the next, or over multiple years. So we can identify trends over time. This will help us to answer questions like, by what percentage did cash change or increase or decrease last year? When we make computations for horizontal analysis, we can show each item as a percentage of the base year or as a percentage change. If we want to show the items as a percent of the base year, we would take the current year amount divided by the base year amount. Now keep in mind the base year is generally the earliest year shown. So if we have 3 years of financial data, it would be the earliest year shown. We can also find the change in that account and divide by the base year amount to find the percentage change. So as an example, we are going to turn our focus to Aggie Inc. So look at the financial statements. We're going to look at the cash account, so look at the balance sheet. You could present the balance sheet as a percentage of the base year. There are 2 years shown, 2009 and 2010. So the base year is 2009. That's the earliest year shown. So we will take the cash of $6,000 and divide by the cash in the base year of $5,000. So we could say cash is 120% of what it was last year in 2009. Now the other way we can show this is as an increase. So we see that cash went from $5,000 to $6,000. So as a percentage change, we would take that $1,000 increase and divide by the base year of $5,000. Then we would say that cash increased 20% over the year. So you can see these ultimately give the same answers. One just shows that cash in 2010 is 120% of what it was in 2009, and the other one shows that cash increased by 20% during 2010. Now what you'll find as you move through the lecture notes is I did go ahead and take a snapshot of what horizontal analysis for Aggie Inc. could look like. In this one I showed the percentage increase or decrease, with decreases being shown as negatives. So cash increased 20%, accounts receivable decreased 22.22%, inventory increased 15%, and so on. You could look at each of these items and compute it. We can do the same thing for the income statement. Just show that sales increased by $6,000, and that's a 6.74% increase. Cost of goods sold remained the same, so that's a 0% change. And then, of course, so on and so forth throughout the rest of the financial statements. Now we'll turn our focus to the vertical analysis tool. In vertical analysis, what we're trying to do is evaluate the relationships within a single financial statement. And so we're going to be looking at a given year, not a trend over time, but a given year. Now, we will compare our answer to prior years, but when we're making the computations, we will be looking at a single year's financial statement. We can also compare to other companies or industrial averages. So what we'll do is express each item in the financial statement as a percentage of a select item on the statement. So what we mean by that is that for the balance sheet, everything will be expressed as a percentage of total assets. The formula is account balance divided by total assets. So if we look at Aggie Inc. financial statements and we look at inventory, the inventory account shows a balance of $23,000. Total assets in 2010 are $93,000. So inventory is 24.73%. What that tells us is that inventory makes up 24.73% of assets during 2010. Now what we might do with this number is look at the prior year and see what percentage inventory was for as compared to assets, say in 2009 and 2008, and look at what's happening over time. I show a balance sheet with all of the vertical analysis calculations. Every single one of these accounts for both years is shown as a percentage of total assets. So cash in 2009 makes up 5,000 of 86,000 of assets. Accounts receivable makes up 18,000 of 86,000, or 20.93% of assets. Same thing here in 2010. Cash is $6,000 over $93,000, or 6.45%. Accounts receivable is $14,000 divided by $93,000, or 15.05%. So we can see inventories as a percentage of assets is decreasing over time. And you will do that for each account in the balance sheet. Now for the income statement, you will express all items as a percentage of net sales. So your formula is the account balance for each account on the income statement divided by net sales. So if we look at Aggie Inc. financial statements and choose wages expense, we will see that wages expense was $27,000 in 2010 and sales were $95,000. We're not given a net sales amount, so we'll just have to use the information that we do have, and that's that sales were $95,000. So the answer is 28.42%. And what this tells us is that 28.42% of sales went toward covering wages expense during 2010. Now on the next slide, you will see an example of all of Aggie Inc.'s income statement shown in vertical analysis format. This is also called common size format. So in 2009, sales make up 100% of sales. Cost of goods sold was 48.31% of sales. Depreciation took up 8.99% of sales. Wages 23.6% of sales, and so on. Now this shows some important relationships regarding profitability, because we can see that for Aggie Inc., gross margin was 51.69% of sales in 2009 and 54.74% of sales in 2010. So inventory costs were less as a percentage. However, when we go down here and look at the net profit, income was 10.79% of sales in 2009, but only 8.42% of sales in 2010. Now in the remaining presentations, what we're going to look at is the third tool, which is ratio analysis. And what we're going to do there is look at the mathematical relationship between two or more financial variables. Usually these variables are going to come from either the income statement or the balance sheet. Occasionally they will come from extra information. We will classify these ratios into three categories. They are the profitability ratios, liquidity ratios, and solvency ratios. And you will see a presentation for each of these three in the Blackboard learning module for financial statement analysis. Now just a couple of general things before we get into those presentations. First of all, some of your ratios are going to require an average balance for the year. So that would be beginning balance plus ending balance divided by 2. Now when you look at Aggie Inc. and realize that we know the balance at the end of 2009, that's going to be the beginning balance for 2010. Then when we look at the 2010 column, that will be the ending balance for 2010. So you will typically see, at least for your balance sheet, 2 financial statements, 2 years worth of financial statements, so that you do know a beginning and an ending balance. Right, now the other thing, there are going to be 15 or 20 formulas, and these ratio formulas will be provided on the exam. You're going to want to stop and make a note that this means that the ratio formulas shown under Roman numeral 4, ratio analysis, in your lecture notes, will be included and labeled. This does not include the formulas for horizontal and vertical analysis. So make a note now in your lecture notes so that you will know that as you begin to study for the first exam. Now, as you're ready, go ahead and look at and go through the presentations for profitability ratios, liquidity ratios, and solvency ratios. See you then.